There's a debate going on right now in the investment community over whether or not to invest in the stock market or invest in cash, i.e., T-bills. And the reason this is so popular is because right now, T-bills or short-term treasuries are paying more than 5%. And that's pretty much on a risk-free basis. You're investing in short-term treasury bonds backed by the US government, so they're relatively risk-free. So that's what I want to discuss today, is the idea of investing in cash, i.e. T-bills, or the stock market. Before I go into the details, I want to take a quick look back at historical performance of, let's say, the stock market compared to T-bills. And I want to go back to about 2008 and 2009, right around the great financial crisis, just to look at how the stock market has performed relative to T-bills. If you look historically, at least based on the past 15 years, you're going to see that stocks have significantly outperformed cash. And if you think about it, it kind of makes sense, because after 2008 and 2009, the great financial crisis, the Fed cut interest rates down to pretty much zero. And they remained there for a considerable time, up until recently when the Fed started raising rates just a couple years ago. So historically speaking, over the long term, stocks defined by the S&P 500 have outperformed T-bills considerably. I think it's like you would have had 4 times as much money going back to the beginning of '09 investing in stocks as you would have by investing in T-bills or cash. But the landscape looks a little bit different today, right? We have T-bills, and I just looked an hour or so ago, and short-term treasuries, anything less than 1 year out in maturity, they're paying, I think, right around 5.3 or 5.4%, which is a pretty reasonable rate of return, again, on a risk-free basis. So now the question then becomes, okay, if I'm someone in retirement or nearing retirement and I want to invest for the future and I don't want to take too much risk, why would I invest in the stock market and take all of that risk and volatility when I can get 5% or more on something that's ultra safe? And it's actually a very good question, and I see it popping up a lot, not only in conversations with clients, but also in the Wall Street Journal and in CNBC. Before we address that question, it's important to first provide some level of context around that question. And that pretty much goes for any personal finance related question, whether that's, questions I get will be like, Eric, should I invest in Nvidia? Should I buy Bitcoin? Should I buy Series I bonds? Those questions are so hard to answer if I don't know anything about you or your personal goals or your risk tolerance or anything specific. I have to provide some personal context to that question in order to determine the best course of action for you moving forward. What I want to do today is go through 3 different considerations, 3 questions that I think every investor should ask themselves before they just go out and buy a T-bill and sell out of everything in their portfolio just because they want to get a 5% risk-free yield. So here are 3 considerations, 3 questions that I think every investor should ask themselves first. So let's start with consideration number 1. And that is, what are you investing for? Ask yourself, what am I investing for? And this simple question, I think, is often overshadowed by the latest and greatest financial trend in the media, whether it's T-bills paying 5% or Bitcoin or AI. I think the focus just goes on that juicy 5% yield, and a lot of people just disregard the fact that maybe I should think about, what am I actually investing for? What's the bigger picture? So before just plunging headfirst into a new investment idea, whether that's a 5% T-bill or Bitcoin, just step back and ask yourself, what are you investing for? Is it for retirement in 10 years, a down payment on a vacation home? Getting clear on the bigger financial picture, I think, will make it easier for you to determine the best course of action moving forward. So let me give you an example, a couple examples actually. So assume we have someone who's recently retired, and let's say they have a couple $100,000 in cash sitting in a large bank account paying 0.1%. And they're looking at everything right now. They're reading articles in the journal that is showing high yield money markets paying 4.5% and T-bills over 5%. And they simply just want to earn more in their emergency fund, in their cash reserves. Well, in that case, then maybe setting aside some of that money in your checking account and buying some T-bills or opening up a high yield money market account might make sense, right? That strategy aligns with your purpose. You want to keep your reserves safe. You don't want to risk it in the market, but you just want to earn more than what your current bank is paying. So in that case, in that example, that might make some sense, buying some T-bills. Now, let's look at another example. Let's say you have a 40-year-old tech executive earning a high six-figure income and generating a substantial amount of cash flow every month, and that person is focused on aggressive growth for an early retirement. Well, in that scenario, a 5% T-bill might not make the most sense. That individual may be better suited to invest in a diversified portfolio of stocks, start a side business, or invest in some real estate, whatever their specific goals are. T-bills might not be best suited to help that 40-year-old achieve their goals. So you see what I mean here. You have to go deeper than surface level, i.e., should I invest in this or should I invest in that, and consider bigger, more meaningful factors such as your specific goals, your risk tolerance, and time horizon when making any investment decision. Consideration number 2, ask yourself this: where is the money coming from and why? And it doesn't matter if you're buying marketable CDs or call options. Any purchase of a marketable security, for the most part, is going to require cash. And that cash has to come from somewhere. It could be a bonus that you got paid at work, or it could be from selling out of another mutual fund that you have in your portfolio. Whatever it is, the cash that you're looking to invest in either T-bills or the stock market has to come from somewhere. And identifying the source of funds, where that cash is coming from, is an integral part of the decision-making process, as it forces us to confront our overall financial objectives and question why we're considering this new perspective idea. I think it's best here if I illustrate through examples. So let's take a common example that I think a lot of investors are considering at this point is they have some cash in their portfolio. Let's say they have some cash in their IRA, call it $200,000. And they're looking to either invest in T-bills because they just read an article in the journal that T-bills are paying 5.5%. So they're considering doing that, or maybe just investing in another diversified portfolio of stocks. Now, let's say that $200,000 came from that individual, that investor, selling out of a large cap growth mutual fund. So they sold a portion of their fund, got $200,000, now it's sitting in cash, and they're wondering, okay, should I do T-bills or should I do some other stock strategy? So in this example, ask yourself, why am I doing this? And we know where the cash came from. It came from selling out of a stock fund. So then ask yourself, okay, why am I doing this? Why do I have cash here? Why am I considering a 5% T-bill? And here are some acceptable reasons in this example why that might make sense. So number 1, you could be just adjusting your risk profile down to something more moderate. So let's say you were once an 80-20 allocation and a little bit more aggressive, but now in retirement, you realize that you don't need to take as much risk. So you're moving your risk profile down a bit to be a little bit more conservative. In that instance, yes, T-bills might make sense. Another reason why that might make sense is you simply are just rebalancing your portfolio, right? Assuming you started out, let's say, at 80% stock, 20% bond allocation, and now your allocation is closer to like 95% stock and only 5% in bonds just because the market's gone up. Well, you might simply just be reducing your stock exposure, adding some bond exposure through your T-bills, and getting back to that 80-20 balance. So in that case, investing in T-bills and pulling cash from that stock fund and investing in T-bills, that might make sense. It's part of a more comprehensive investment strategy, right? You're rebalancing back to your objective. Another reason why that might make sense too is because you want to raise some cash for an upcoming expense in retirement. So let's say you want to take your family on a big lavish vacation and you want to have cash set aside in the next 6 months in order to do that. Instead of just sitting in cash in your portfolio earning nothing, you want to have that cash earn a little bit more. So in that case, yeah, T-bills might make sense. Taking some cash out of the market, setting it aside in T-bills because you have it earmarked for a future retirement expense. Now, where it might not make sense in this scenario, and I think a lot of investors I see kind of going down this path, especially now, is I can see someone saying, you know what, I want to take some of my chips off the table. I fear that a recession is coming and I want to sell out of the market and I want to go into cash or short-term treasuries to get that 5%. And then what I'm going to do is I'm going to wait until that recession hits that everyone's calling for. And then when the stock market goes down, I'm going to get out of my T-bills and I'm going to take that money and I'm going to go back into the stock market. So I'm buying at the lows. Now, in that scenario, I probably wouldn't advise on selling out of stocks and going to T-bills, because what you're doing there is you're trying to time the market. You're playing a fortune teller. You're trying to predict exactly when something in the future is going to happen, and then predict even further when the market's going to come back up. History has shown that trying to time the market, when to get in and when to get out, is nearly impossible to do consistently well over time. And that goes for retail investors all the way up to the professional investors that do this every single day. So remember, the source of funds for any potential investment should always be addressed and aligned with a why that's rooted in a disciplined, comprehensive investment strategy. That does not include trying to time the market. Lastly, consideration number 3. What you want to consider here is what's called reinvestment rate risk. Now, the Fed has recently raised interest rates another 25 basis points, and that pretty much takes the rate environment now to the highest it's been in, I think, about 20 years. The Fed also said they may need to cut rates in the future. That's important to know and understand what's going on in the interest rate environment, because it addresses this notion of reinvestment rate risk, which is the risk of investing future cash flows from interest payments on bonds, and when bonds mature, it's investing those future cash flows at potentially lower rates. So just take the 5% T-bills right now as an example. Those 5% T-bills, yeah, they're earning over 5% yield today, but that's not to say that they're going to earn 5% next year or the year after or the year after that. When those 5% T-bills, when those interest payments start coming in and those bonds mature in the future, you as an investor are going to have to do something with that cash. If your intention is to keep buying treasury bonds or short-term debt, then you may be reinvesting in the future at lower rates if the Fed decides to cut. And if we do go into a recession, more than likely the Fed may indeed need to bring rates down. And the more severe the recession, the more the Fed may actually need to cut those rates. And I think reinvestment rate risk is something that a lot of investors aren't necessarily considering right now, because they're just focused on that 5% yield and the fact that it's risk-free and that they're pretty much guaranteed to get 5% back on their money in a year or less. And they're not necessarily thinking about 2, 3, 4 years from now what they're going to have to do with those proceeds when those bonds mature. It's important that you address reinvestment rate risk when considering cash or short-term treasury investments, and be sure that you have a plan for investing those future cash flows. Anytime I hear investors ask specific questions like, should I invest in cash or should I invest in the stock market? I know right away that there's something deeper driving the inquiry. And almost always, it's driven by something emotional or uniquely personal to them. So remember to assign your own context when presented with a new investment idea. T-bills may be a good fit for one type of investor and a bad fit for another. Understand that not everything you hear in the media pertains to you, and that no investment is exempt from all risk, including cash. And never be afraid to challenge yourself by asking questions that will elicit the true why behind your intentions. When in doubt, ask a professional for help. Thanks as always for watching our videos. If you're interested in staying up to date with our market financial commentary, please subscribe to our blog at oneupfinancial.com/blog or follow us on LinkedIn and Facebook. Thanks again, and we'll see you in the next one.